This is a chart of the UK's GDP from the year 1600 to 1900. The economy grew by about 50% over the course of 300 years. But something happened in 1882 that changed the course of economic history forever, and turned this chart into something like this, a parabolic increase in the size of the economy. And it wasn't just the UK. This phenomenon happened across developed economies in the 1900s and 2000s. And believe it or not, we may have just seen a very similar event to 1882 happen today. That year can be marked as the moment where electricity was first made available for commercial use, enabling it to be used in people's homes for light, electrical appliances, but also enabling a complete transformation of industry. Electricity can be classified as a general-purpose technology, meaning it has the potential to impact almost every aspect of human life. And as we just saw with that chart of GDP, it very much did so. Today's comparison, as you may have already guessed, is none other than artificial intelligence, also a general-purpose technology, or GPT for short, that could completely alter the future of the economy. Now, some believe that AI will inevitably lead to an economic collapse, as it has the ability to replace many jobs in the economy, while some have a much more optimistic perspective on how it can increase productivity. So we're going to look at exactly how AI could impact economic growth, the job market, along with stock market performance, and how we should take this new technology into account as investors. The IMF has estimated that AI could provide roughly a 0.5% boost to GDP. PwC, a consulting firm, estimates that AI will roughly have a 0.8% contribution to GDP. Now, a 0.5 to 0.8% boost to GDP may not sound like much, but this has the potential to completely shift the trajectory of the global economy over the next 20 years. This is, in fact, roughly the same impact that academics estimate electricity had on GDP in the decades of its adoption. For comparison, the steam engine's estimated GDP contribution was around 0.3%, and the internet's impact was also roughly a 0.3 contribution to GDP. So there is no question about it. Artificial intelligence is one of the most important technologies that has been invented in the last 100 years. But what does this all look like on an actual chart of GDP? Over the last 20 years, the US economy has grown by around a rate of 2% per year. If that continues over the next decade, this chart would look something like this. But with the boost in productivity from AI, GDP growth would look something like this. Now you might be thinking here there really isn't a big difference. But look at what happens when we fast forward another decade. The gap gets larger. Add another couple of decades and the gap between the economy with and without AI starts to get pretty impressive. It's on these kinds of timeframes where you can see the real impact of transformative technologies on the economy. It's slow and probably unnoticeable at first, but over the long run, it compounds in a massive way. And most people can probably relate to this. The reality is that AI has not changed the world since ChatGPT was released in 2022, but do not mistake this for a lack of impact on the economy. It's a question of time before AI's impact gets reflected into economic growth. Electricity is a great example of this. It was also a general-purpose technology that slowly rewired the economy and then unleashed a wave of productivity. Research from the IMF shows us that the adoption of electricity followed an S-shaped curve, beginning very slowly in the late 1890s and early 1900s, but in the 1910s and 20s, it picked up quite aggressively. These 30 years right here is where global GDP jumped up very rapidly, and the end of the S-curve right here in 1929 marked the onset of the Great Depression, which brings us to the second question of this video. Is AI going to cause a massive economic crisis as it replaces an entire portion of the workforce? After all, a higher level of productivity also means that businesses can produce the same amount of goods and services, but with fewer workers. If the economy slows, it could be that businesses that have been integrating AI will be very quick to lay workers off. And it could even make some jobs completely irrelevant as they get fully replaced by AI. That could mean an increase in what's called structural unemployment, which is when people no longer have the skills required to find a job in the new economy. Multiple academic studies have looked at how new technologies in the early 1900s likely contributed to higher levels of unemployment during the Great Depression, and many are very worried about history repeating with AI, with some predicting that US unemployment could rise to 20% by 2030 as a result of AI replacing jobs in sectors like law, finance, and consulting. The truth is, new technologies like AI are going to disrupt. There will be positive disruptions, but also negative disruptions. If we come back to our chart of historical GDP, we see that the second industrial revolution that was powered by electricity created an initial boom in the economy, and this was followed by a lengthy decade-long readjustment phase during the Great Depression, which was then followed by a second massive boom in GDP. Now, if we look at what's been happening more recently, we see that GDP has been leveling off since the 1980s. We think it's entirely possible that AI technology has the potential to trigger a secular re-acceleration of economic growth. Now, similar to the 1910s and 1920s, also known as the Roaring Twenties, this re-acceleration of growth could be accompanied by a speculative boom in stock prices, and could also be followed by a similar readjustment phase, which could come under the form of a very severe recession with high levels of unemployment as the economy takes time to adapt to the new technology. So what does this all mean for the US stock market? A massive melt-up or a massive crash? Well, the stock market ultimately tracks real economic growth. So the impact of AI on real GDP that we discussed earlier could be very minimal at first, but accelerate as time goes on, leading the stock market to incredible heights. AI really doesn't tell us much about what is going to happen over the next 5 years, and the stock market's performance will be much more based on the typical cycles of the economy rather than any real impact from AI. Back in the early 1900s, even though the economy was in the early phase of being completely rewired by technological advances, you still had multiple very serious economic downturns like the 1920 recession that triggered a 60% decline in the stock market. What is certain is that investors who held through these periods, or even better took advantage of the declines in stocks, were able to benefit from the boom in asset prices that followed. The aim of this video isn't to predict exactly what's going to happen as a result of AI, but instead to try and paint a very rough picture of how things could turn out. Many people are very worried about the future today, because we have lots of negative news on this subject being spread left and right. But the reality is, people have been worried about every single technological invention that has been made in the past. All of them had very real risks, and most did cause disruptions, but humanity survived and even thrived in the long run thanks to these inventions. We happen to believe that AI will present some of the biggest trading opportunities of our lifetimes. If you're ready to take advantage of them with us, make sure to join our service.